Hey, hi, everyone. Thanks for joining another American Mortgages Global Mortgage Group webinar. My name is Robert Chadwick, one of the co-founders of American Mortgages and Global Mortgage Group. I'm sure everybody is probably quite aware of what we do, but I'll give a little bit of an intro, and then I will introduce our special guest today. So as a company, American Mortgages is only focused on providing U.S. mortgage financing for foreign nationals and expats. That's all we do. 100% of our clients are living somewhere overseas, earning their income abroad. We have loan programs in all 50 states. Minimum loan amount is $150,000, and there is really no maximum loan amount. In general, you can qualify for up to 75% financing for investment properties, again, in all 50 states. You do not need a U.S. credit profile, U.S. credit score, and earning foreign income abroad is exactly what we do. So with that said, I'm happy to answer any questions that anybody may have on mortgages after the webinar, as well as our guest will also be answering any tax questions. So this particular webinar has been requested by many people. I think in general, there is a very big misconception of the tax implications or requirements in the US. So today we have James Slouber, who is a managing director of CBIZ Tax Department and has been with the firm for over 25 years. Jim specializes in providing business and individual tax advice to foreign nationals and U.S. expats regarding their investment properties. He has got years and years of experience, and his specialties are very specific for what our clients would be looking for. So with that said, James, perhaps maybe you can introduce yourself and tell us a little bit about the company, and then we will be reviewing or going over questions that have been provided by clients in the past that we've taken down, and questions that have recently been requested since we announced this webinar. So Jim, I know it's quite early in California, so I appreciate you taking the time and joining, and perhaps maybe you can introduce yourself and go into what you're offering, your background, and then we'll discuss and go over the questions.
Well, thank you, Robert. Yes, I'm a tax CPA. CBIZ is actually a publicly traded company, which is unusual for accounting firms. We're probably about the 10th largest firm in the United States. It kind of goes back and forth. So we've got significant size. We are part of the Creston International Network, and Creston is an affiliation of CPA firms, accounting firms across the globe. We probably have firms in about 140 countries or so. So it's a significant organization. I do a lot of real estate, and typically real estate is more partnership oriented. I also have some small public companies, do deals, a lot of tax planning, and I do about a third of my time in international tax, and that covers individuals as well as businesses, inbound and outbound as well.
Great, thanks, James. So I think just for a matter of time, let's get into the questions. So I'll ask the questions that clients have asked, and then you can provide a detailed answer on this. So the first question, and this is actually very common in most countries, is stamp duty required when I purchase a home in the US? And maybe you can kind of expand on this.
Sure. No, the short answer is no, there is no stamp tax duty. You'll find when you're purchasing or selling a property, there's going to be a lot of hands out in the escrow process. There's a lot of fees and costs and a variety of things that are going to pay, but there is no stamp tax duty per se.
So I think if you were to kind of expand on the stamp duty, the US, from my understanding, is probably one of the few countries for international investors that don't have a stamp duty. So there's no extra requirement for a foreigner to pay taxes than a US citizen would pay, except maybe on the exit of a property. I believe there's a FIRPTA tax, but maybe you can sort of cover something on the FIRPTA.
Oh, well, the US tax system, it really depends upon your status, how it's going to apply to you. So there's, first of all, US citizens, and so foreign nationals can be dual citizens. If you're not a dual citizen of the United States, then the question is, are you a US resident? And if you're not a US resident, then you are a US non-resident. US citizens and US residents are subject to global taxation in the United States. So it doesn't matter where you live, it doesn't matter where your income is from. If you're a citizen or US resident, everything is subject to tax in the United States unless it's specifically accepted by statute. Because it's a global system, there's a foreign tax credit, which is supposed to reduce or mitigate or eliminate the double taxation, because it will happen. You're going to have tax offshore as well. If you're not a US citizen or a US resident, then you are a US non-resident and you're subject to tax solely on your US source income. And so that is a very big distinction. And we can get into more details as we go along.
Okay, perfect. Thanks. Okay, number two, how do we handle the rental income from a US property when it comes to a tax perspective?
So I can give you a definite maybe. It depends upon your tax status. So first of all, if you're a US citizen or US resident, it's going to be a net tax system. You're going to look at your rental income, less your rental expenses. It's going to give you a net number, and that net number, taxable income or loss, is what would be in your US income tax return. When it comes to US residents, there's two concepts there. One is, do you hold a green card? And you either do or you don't. And if you don't hold a green card, the second test is, do you meet the substantial presence test? That's a 3-year rolling average that looks at the number of days that you spend in the United States. And so you're looking at all your days in the current year, a third of your days in the prior year, and then 1/6 of the days in the second preceding year. If the sum of those days is at least 183 days, you're treated as a US resident and taxable on your worldwide income. So once you get out of those two hurdles, if you don't meet those, you're a US non-resident. A US non-resident, again, is subject only to tax on their US source income. But there's two concepts there. I'll just call it generally investment income and the other business income. Investment income is subject to tax on a gross basis. So you look at things like interest and dividends, royalties, there's a flat 30% US tax withholding on that source, that type of income. So it's gross. Rents, it's complicated because you can either be an investment activity or a business activity. And if you're investment activity, it's gross taxation. So you can't consider your rental expenses, which is a terrible answer. If it's a business, then you're looking at net taxation. And in that situation, what we find most of the time is there's an election. If you're not meeting the business standard, you can make an election to tax yourself as a business. And so most of the time people will make that election, so you're subject to net tax. And as far as you're going to be looking at your rental income and then all of your allocable expenses, mortgage interest expense, real property taxes, insurance, if you're paying utilities, repairs and maintenance, and then you get to depreciate your property as well.
So there can actually be a significant savings depending on how it's structured
Right.
using, professional advice like yourself. So.
Right. It's very important because, and just as a general comment, if you don't hold a green card and you're not a U.S. citizen, if you're spending a lot of time in the U.S., you've really got to watch out for that 183-day test, because if you can fall into this trap and suddenly you're taxable on your worldwide income, which is a very bad answer.
Right, exactly. So, okay. So I think you touched a little bit on this in your earlier answer, but number 3, can we write off interest, taxes, and property management fee?
Right. And again, as long as it's treated as a business activity, the answer to those are yes. Those are all good deductions.
And how would you treat it as a business expense? As the title or the property would have to be held in an LLC or some sort of entity, or could you still do that with the title being held as an individual and still treat it as a business?
The practical problem is there's not a clear line or path to make the distinction between a business and an investment. A business, just, if for example, if you're holding one property and you're not managing it, it's going to be treated as an investment. Do you need to hold 4 properties, 3 properties, 10 properties? It's not clear. And so that's why this real U.S. real property business election is so important. And I've got clients who, have 10 properties, they're managing them, and we're still making the election because we don't want to take the chance of gross taxation on that rents. And just as a quick example, if you've got $50,000 of rental income and $50,000 of rental expenses, that's zero tax income. If it's an investment, you're paying $15,000 of tax, 30% gross on that rents, even though you've got no taxable income. And if it's a business, you've got zero. So there's no tax liability. So very, very important on that election. And it doesn't matter. You can have a business whether you hold it through an entity or not. And I think we're going to talk more about holding it and owning it in a moment.
Okay. Okay. So, as a mortgage brokerage, most of the time there is a brokerage fee that we charge the clients. Now, whether they're financing it into the mortgage or they're paying it out of closing, is the mortgage broker fee a tax write-off especially when they're buying an investment property?
Yes and no.
Okay.
You'll hear that a lot from tax guys. You hear a lot of that from tax guys. All of the costs associated with obtaining the loan are capitalized, and then they're amortized over the loan term. So if it's a 10-year loan, $10,000 of loan fees, you cap it and you take $1,000 a year against your rental property. And if you sell it in year 3, the balance that you haven't amortized is deductible in that year. So you'll get it, but it just takes a while.
Understandable. So I guess the short answer is, over the long term, amortized out, you'll
get it.
Tax write-off. Yes.
Right.
Okay. So number 5, we have a few loan programs that require a client to use a U.S. LLC. Mm-hmm. When they hold the property individually and transfer to an LLC, does this trigger any kind of tax consequences?
Generally not. There's a lot of issues with LLCs. One of the things is there's lots of litigation in the United States. And so having a legal entity between yourself and that rental activity can protect your personal assets. So it is very common to use an LLC to hold real estate. If you're the sole owner of that LLC, it's disregarded for U.S. income tax purposes, which means even though it's a legal entity, the rental activity is still going to be reported directly in your U.S. income tax return. If it's disregarded, and you already own that property and set up your LLC, you can contribute it to the LLC without any tax consequence because it doesn't exist. If an LLC has 2 or more owners, it's treated as a partnership. and it's going to file a partnership return. A single member LLC does not file a tax return. But the partnership does have to file a tax return, but otherwise it's pretty similar. And most of the time when you contribute real estate to it with a mortgage, you're not going to have a tax consequence.
Thank you. Now, number 6, I think there probably needs to be maybe a double explanation on this. For one, what is a 1031? And then, of course, the question, so can a non-US citizen use a 1031 exchange when they sell a property? We have a lot of clients that have a lot of properties. A lot of people will sell and then buy a more expensive investment or something similar to where they can use a 1031. So perhaps maybe you can address that question and also just give a general overview of what a 1031 exchange is.
Sure. The starting point is, even though the rental activity could be treated as an investment and subject to gross tax, the disposition of a U.S. property is treated as a business activity and it's subject to tax, period. And so the gain on sale is going to generate a tax liability. And so if you're going to sell it, there's a couple of strategies, but one of them is the so-called like-kind exchange, Section 1031. And basically what you're doing is you're going to sell your property and reinvest in a new property. And as long as you reinvest at least as much as what you sold it for, you can defer that gain. And so just as an example, if you bought it for $1 million and sold it for $2 million, you've got $1 million gain. If you buy another property worth at least $2 million, you can defer that $1 million gain. And it's a deferral. What will happen is the $2 million cost of your new property will be reduced by the deferred gain. So your basis is only $1 million. So when you sell that property in a taxable sale, the whole gain is going to be subject to tax, but it's a very, very efficient deferral strategy. And just as a side comment, you're always going to want to have a qualified intermediary acting as your middleman in an exchange. The rules are complicated and meticulous, so you have to be careful to do it right. U.S. non-residents are able to use like-kind exchanges, but there's limitations. And the biggest limitation is if you're going to enter into an exchange, your target replacement property must be located in the United States. And if that is not what happens, it's not going to be deferred.
That's interesting because this was actually a question the other day that a Singaporean owned a property in the US that they were selling, and they wanted to know if they could use a 1031 exchange to purchase a property in Singapore, which it seemed like it wasn't logical, and I'm assuming that it's not. Right. Okay. All right.
And you're right. The rules are complicated, but that really is the net answer.
Okay. All right. So it's like properties, but all within the U.S. Regardless if you're a U.S. expat or you're a foreign national, you're still able to take advantage of that program. Now, for the 1031s, is there a maximum number of 1031 rolls that you can do, or you can just continually do it?
Right. And it's very, people that are big in real estate, I've got clients that we've done 10 exchanges. So it's a rolling thing, but basically once you sell and reinvest, you would really want to hold at least a minimum of 2 years, because if you're constantly rolling them every 6 months, you have a question about whether you've really held it for investment or business use. So there's practical limitations, but you could literally roll it every 2 years, typically without a problem.
Interesting. Okay, number 7. How do they handle tax reporting in the U.S. if they don't have an ITIN or Social Security number?
It's a pain. It's a laborious process. The rules are constantly changing. You might have heard that the IRS is dismally behind processing. So it's a pain in the posterior. One of the alternatives that we've talked about a little bit is if you're going to use an LLC, it's easier to get an ID number for an LLC than it is for a foreign individual. We just did one recently and it took about a week. Whereas with individuals, I haven't tried one lately, but you want to get on that process early on if you're thinking about investing in the US.
So number 8, and I think this is, I think this is a question that comes up a lot, but I think just from the answer that you gave earlier, I think if I could kind of comment on it. So number 8, the question is, once a client has US exposure, is he required to pay global taxation? From my understanding and how you explained it earlier, if somebody spends 180 days, I believe you said, in the US, they're going to be required to pay global taxation regardless. Correct. Regardless if they own real estate or they don't own real estate. So yes. Maybe you can kind of sure. Go into this in a little bit more detail.
Right, and so we're back to those those tests. So if you are a US non-resident, you're not spending more than 183 days over this rolling 3-year period, you don't have a green card. And so as long as you meet those tests, you're subject to US tax solely on your US source income. So if you got rental property, if you've got dividends and interest, those sources of income out of the United States will be subject to tax.
Okay, but in general, somebody owns U.S. real estate, they're still living in whatever country they're at, they go back and forth on vacation or whatever it may be, as long as they don't spend more than 180 days, then the tax is whatever would be on the
right. on solely U.S. source taxation. Okay. So you just got to be mindful of that rule, and if you're spending a lot of time in the U.S., you need to track your days, because it's a rolling 3-year average.
Okay. Now, this actually isn't a question, but when we were just discussing this, we've had many clients ask, when they buy a U.S. property, say I buy something in Florida near Disneyland, California near the beach, wherever it may be, am I allowed to visit that property to inspect it and write that travel expense off my taxes? Good
question. Yes. I can give you a definite maybe again. It is not unreasonable to have trips to the U.S. to inspect your property and to look at it. So a trip a year probably will work okay. The question is, are you flying first class? Are you staying in first class hotels? Are you coming for 2 weeks to spend 1 day at the property? Those are all negative factors. So, looking at the direct costs, you probably can.
Okay. So it's probably advantageous to buy something in Hawaii or next to Disneyland then.
Yes, but just again, if you're taking a 2-week trip and you're spending 1 day at the property, really that means 1/14 of those expenses would be deductible. So it's looking at your business versus your total activity. Okay. So you keep that in mind and take it from there.
Understand. Okay, number 9. What are the tax deductions that could be taken or you're entitled to as a foreign national real estate investor?
Sure. And back to the same threshold question, is it an investment or is it a business? If it's an investment, there are no deductible expenses. So we want to make that trade or business election typically. And as long as it's a business activity, all related expenses will be deductible. Kind of recapped it before. Mortgage interest, property taxes, insurance, if you're paying utilities, repairs, maintenance, and depreciation on the property, and property management fees.
Okay. So basically what you're stating is, regardless of how you own this property, whether it's an LLC or an individual, you want to elect that this is treated as a business and not an investment, regardless of the properties you have.
Usually that's going to be the case.
Okay. What is required to pay tax and at what rate? I think it's kind of a general question, but
Sure. Again, we get back to is the nature, first of all, are you a U.S. non-resident? And if as a U.S. non-resident, the rates are the same as a U.S. resident. They're graduated, but it depends upon the type of income you've got. If it's interest and dividends, it's subject to a flat 30% withholding rate. And I'll talk a little bit more about that in a moment. So no deductions, it's just money out the window. If it's a business activity, such as the rental, you're looking at your net number. And if there's taxable income, the rates range from 0 to 37% under our current tax structure. And one other thing I didn't mention, capital gains are not subject to U.S. tax. So if you've got a brokerage account, and you've got interest and dividend income, that's gross withholding tax, but stock sales are capital gains and they're not subject to tax. So, we've got this dichotomy. And then if it's real estate, even though it's capital gain, it's subject to tax. So.
Okay. So, I mean, what you've been saying is as long as you treat this as a business,
right,
you can mitigate a lot of tax consequences
right.
In the US. And I mean, depending on how it's structured with a professional like yourself, you could hopefully offset each other, the expenses to the taxes. Okay.
Right.
All right. So this is a couple more questions that was from a few clients. Excuse me. Can an LLC undertake other businesses such as trading and financial instruments, provide design or consulting services, basically non-related to the real estate that the property is holding, I suppose, would be the question. If the answer is yes, can the P&L calculated for tax purposes can the P&L be calculated for tax purposes on all of the activity? That's a very long question.
Right. Yeah. And so the short answer is yes, the LLC can do all of those things. But you're going to have to segregate your activities. Your trading activity is going to be capital gains and losses. And as I said, that those cap gains should be exempt from U.S. tax. Your rental activity is going to be separately stated on your tax return. If you've got a consulting business, that's a separate activity as well. So rental activities usually are subject to something called the passive loss rules. And the passive loss rules mean that if you've got a loss, it's not currently, you'll aggregate all of your passive activities. If there's a loss in the current year, it's not deductible and it will carry forward until you've got income or you dispose of that property. So in this example, if you've got consulting income of $100,000 and a rental loss of $100,000, the loss probably will be suspended and the $100,000 of business income will be currently taxable at graduated rates. And your interest and dividends are subject to gross withholding tax. So
would your recommendation be, if you are to hold a property in an LLC, not to do any other activities?
Well, you can do it. You can do it. It's just, it's going to be the same as if you didn't hold it through the LLC.
Okay. All right. So regardless,
but it doesn't hurt. It doesn't.
Okay.
There are other issues that may make sense to put them all in there, and it depends.
Got it. Okay. So, excuse me. Next question. In Australia, we are not allowed to claim any traveling costs associated with exploring investment properties, pre-purchase, post-purchase. In the US, is that allowed? I think it's sort of going to what we discussed earlier, but maybe if somebody is looking to buy an investment property, they want to travel to the US and explore what options are available. Is there any kind of deductions on that? I guess it's treated as a business.
Yeah, the exploratory expenses are typically treated as a so-called startup expense. And startup expenses are capitalized And once the activity begins, the business begins. Those expenses have two consequences. The first $5,000 can be deducted, and the balance of those expenses, if there is more, will be capitalized and amortized over 15 years. So it's not the clearest of tests, but it's possible. Once, when we talked about already, once you own the property, you can take some travel expenses to that property, reasonable in amount, and deduct them.
Okay, thank you. What is the tax rate for an LLC, and is it different if the shareholders are non-residents or if they are U.S. Citizens? So basically, if you're a foreign national or a U.S. expat, are you getting taxed at a different level?
Right. The LLC, first of all, if it's a single member, it's disregarded. It's at individual rates. If it's a partnership, it flows through and it's at your individual rates. So the LLC, for federal purposes, does not pay tax. It's a flow-through entity. It's possible to make an election to treat it as a corporation, but that's a whole different subject, and corporations are separate taxpayers with different rates and different issues.
Okay.
So one thing to keep in mind is state taxation. Maybe we'll talk a little bit about that as well. Some states like California, even with the single member LLC, will require an information return. And that information return will have a minimum $800 annual fee plus a gross receipts tax. And the gross receipts tax starts at about $250,000 of income. So most of the time your rentals, unless they're bigger, aren't going to have an LLC fee. But if it's big and you've got $5 million of gross income, your tax annually, your LLC fee will be about $12,000. Most states don't have those rules. So the thing to keep in mind is where you're going to invest, you need to look at the state tax rules before you get there to find out what's going to happen, because most states have a separate income tax. Their rules may or may not follow U.S. principles. If they follow the U.S., they may have a variety of differences. And like some of these, investment versus rental activity stuff may not apply in that state.
Okay. I think kind of expanding on that, is there a particular state, excuse me, is there a particular state in the U.S. that is, I guess, more tax, has better tax advantages over, say, New York to Florida or California to Texas? I mean, if you were going to be a real estate investor, what state would you recommend on a tax basis?
I mean, as an investor, my first concern would be, what's the deal? What is my upside? And so, if you can get the same deal in New York versus Florida, I would take Florida. Florida does not have an income tax. New York has a state income tax and a city income tax. So if you buy something in New York City, you've got two levels of tax plus your federal.
Interesting.
There's several states that don't have income tax: Florida, Texas, Nevada, Delaware. In the other problem with the states are the rules are constantly changing. So you've got to keep your finger on the pulse of what's going on out there. There's an old adage that you can't let the tax tail wag the business dog. So you look at your deal first and then do your tax structuring.
Interesting. I know you're not an attorney, you're a CPA, but this question is, are there other benefits that an LLC would have over an individual, or any disadvantages that an LLC may have over an individual?
Sure. And I touched on that briefly already. And that's if the LLC is properly formed and properly maintained, it should provide liability insulation from the activity in the owner. So the assets of the LLC, in the worst possible case, you get a lawsuit and a judgment against you, they can reach the assets of the LLC, but they cannot reach your personal assets. So that's a big reason to use an LLC to hold, a rental or a business activity. So you've got that level of insulation.
Thank you. The next question is, I think, more relevant to the mortgage financing, but is there a restriction on what type of loans or LTV, et cetera, an LLC can have as opposed to an individual? I'll answer that. As all of our loan programs can either be held as an individual, the title, or as an LLC. Some lenders require one or the other. There are many lenders that can be either. There always will be an individual borrower. So there has to be somebody responsible for the mortgage that the property will be, or the mortgage will be underwritten under, but the entity itself, LLC or individual, is perfectly fine. No reduction in loan to value, no reduction in loan amount. It would be identical regardless of how you want to hold title on the property. Next question. Do you consider projects as part of the EB-5 visa program? If you're referring to if EB-5 is, if you're buying real estate and it's considered as a contribution for the EB-5, it is not. EB-5 are very special programs. And I don't know if James, you have any insight on this, but when it comes to purchasing real estate, I don't know if there's any impact on being able to get the EB-5 program, but it does not count towards the investment for an EB-5. I don't know, James, if you deal with this at all, if you want to.
Yeah, I've got a little bit of experience with it. And, we do have clients that are in the EB-5 program that have real estate. So it can be a benefit under that program.
Okay. So these are some questions from the people that are attending the webinar. Number one is, if I'm looking to expand my property portfolio in the future, what is the best tax structure that one should set up to reduce the tax liabilities? Which are the best options, either C Corp, LLC, individual taxation? If a property is generating negative income or positive income, how would that be treated?
Sure. There's a lot of questions on that one.
As a non-resident, they added that at the very end.
Right. As a non-resident. And so, the first thing to keep in mind is the passive loss rules. So if you're in flow-through entities, everything is going to end up in your individual U.S. non-resident tax return. And so, you'll look at the passive loss rules. You might get around them, but it's not easy to do. And so you'll aggregate. If you got 10 different rental activities, you'll aggregate them. Is there taxable income or taxable loss? And if there's a net loss, that loss will carry forward. If there's net income, it will be subject to tax currently. But the good news is you'll be able to net all of those activities together, all of those rentals, and get a net bottom line number that will give you whether you've got taxable income or taxable loss. Oftentimes what we usually see is a separate LLC for each property. And again, that's for liability insulation. If you've got one LLC with 10 properties and there's a disaster on one of them, all 10 properties could be subject to the judgment. So it's not a tax issue, it's a liability insulation issue. That's why we usually see people set up a separate LLC for each property. That doesn't give you any tax advantages. It's liability protection. The other part of that question is looking at a corporate structure, and a corporation is its own taxpayer. It means that the activity will be reported in the corporate tax return. If there's income, the corporation is liable for the tax. The corporate tax rates are lower than individuals. Right now, the top individual rate's 37%. The top corporate rate in its flat is 21%. individual rates are graduated. So it kind of depends on how much income you've got, because you might be at a 5 or 10% rate based on how much income you've got. So it just depends how much is there. In the corporation, it can provide benefits, but the disadvantage is usually we do not use C corporations for real estate, because there's going to be 2 levels of tax to get your money out. If you sell that property, there's going to be gain inside the corporation, and there's going to be a level of tax. And to get your money out, it's going to be a non-deductible dividend. And the dividend is subject to cap gain rates. So, that may work okay, but there's usually 2 levels of tax, and there's state issues. So that one would take some analysis to go through to see if it makes sense to go in a C corp. One thing we didn't talk about was U.S. estate tax. And so holding real estate through your individual capacity or an LLC may mean that you've got a U.S. estate tax liability if you pass away. And one way to potentially avoid that is to hold it through a foreign corporation. So what we see sometimes are people will hold them through LLCs, and when they're getting older or their health deteriorates, sometimes they get moved into a foreign corporation. The foreign corp is going to pay the U.S. tax on whatever activity is there, but they can avoid estate tax on those properties.
And discussing the inheritance tax, and correct me if I'm wrong, but there's actually an advantage to having a mortgage on a property if you intend to pass the property down to a family member, because you're only taxed on the free equity portion.
Correct.
On the passing of the individual, correct?
Right. It's the net fair market value. So it's the value less the liabilities, just exactly as you described.
Okay, so the higher the mortgage amount, assuming
Right.
the less tax consequences there would be after death. Okay.
Right.
All right. Next question. The business activity, which obviously seems to be the right avenue to travel, who decides that? Is that the IRS, or do you decide that as the individual investor?
I wish it was me. Well, again, we've got a set of tax rules out there. The problem is it's not a clear-cut path. And so it's facts and circumstances. One property probably is not a business. 5 properties probably is. Is 2 properties a business? We're not sure. So it depends. And if it's a hotel, there's substantial services involved with that activity. So the hotel is always going to be a business because there's all this other activity going on. And so, usually if you're not sure or there's questions, that net election is made to treat it as a business.
Okay. Next question. If I'm a US resident and I own 1 rental property with 0 net income, I don't have to pay any taxes if I declare myself as a business. And basically the same question. Can anyone declare themselves as a business?
If you're an individual, you're taxed as an individual. And the only way to change that is to put your business in a corporation, and then the corporation becomes the taxpayer. As a US resident, you were taxable on your worldwide income. So if you got other activities besides that rental activity, all of those are going to enter into your US income tax return unless they're specifically accepted by statute. So we want to make clear, as a US resident, you're subject to worldwide taxation, no matter where that income is from.
Unfortunately, I'm well aware of that.
Yeah, I'm sure you are.
Okay, next question. What about a student owning a house, staying more than 9 months in the US? Is he going to be taxed worldwide? Let me kind of give a little bit of an answer to this, and then maybe you can kind of expand on it. We only provide investment mortgages. So basically it's you're purchasing an investment property. sometimes perhaps second homes. So unlikely a student would be able to be the borrower on these types of properties. So I don't know how it affects a student or if there's any kind of limitations on a student, but in general, to acquire a mortgage, it would unlikely be a student unless they had either rental income generated from that property or it was bought truly as an investment property,
Right.
and they had an income.
The U.S. residency, that is a good question, because there are some exceptions from this 183-day rule, and there are some exceptions for students and trainees and certain types of persons doing different types of activities. So it's fact specific. So just because you're there as a student, you may not be subject to worldwide taxation, but you've got to look at it.
Okay. I mean, it actually makes sense because there are so many people that are studying in the US, and I couldn't imagine that they would all be taxed as, you know, a US resident for that 183-day deposit. Okay, next question. Are there any tax differences between rental income on a second home versus investment property?
No.
Okay.
Same concept. Well, let me clarify that. If the second home is not used for personal purposes, they'll be one and the same. If the second home, if you use it part-time personal, part-time rental, there can be a limitation on rental losses because if you use it more than 14 days a year personally. So you'll segregate the rental activity, come up with a net number. If there's a loss, that loss may not be deductible because of the personal use.
Okay, so in that case, say somebody has a property that they Airbnb it, which is, you know, quite common,
Right.
But they also perhaps, you know, use the property in the summer when school's out or whatever it may be. The tax consequences on that income would be different than if it was just truly an investment property.
The bottom line can be different. All the other concepts are the same. It's just because you've got more than 14 days of personal use, you can get this limitation. If you're in the US and you're working on the property or working for the property and so on, that typically is not considered personal use. So it's a slippery slope. You know, you come in and spend 3 months there, you had a pretty clear answer.
Right. But if you have an Airbnb,
unless you're doing the construction.
right, that's kind of what I was saying. So if you have an Airbnb, you go there for 2 weeks, you do the maintenance, you upgrade it, whatever it may be, then it's probably somebody professional like yourself explains.
Let's take the example that you spend a month there. Well, if you spend 2.5 weeks working on the property, which is possible, you would want to document it, you would not meet that 2-week personal use test.
Oh, interesting. Okay, I think this is something similar. We were just talking about the 1031. As a US expat, can we use a 1031 exchange by selling an overseas property into a US property?
Typically, yes.
Really?
Yeah.
So if I sell a property globally, I can roll the profits into a US property as long as it meets the 1031 rules.
Usually, yes.
Wow, very interesting.
Exceptions to everything, but you know,
Right.
and it makes sense if you're subject to tax on that offshore property. Why wouldn't you be able to exchange into a US property? So
yeah, makes sense. You're great. Okay, next question. Would there be double taxation issue if I hold the property in LLC when I sell it with capital gains, i.e. Charge capital gains at the business level and also at the personal level?
right. And so again, LLC, single member or partnership, are not subject to US income tax. So there is no double taxation. Whereas with the corporation, the corp is subject to tax, and to get the money out, there's a second level of tax. So that's the distinction.
Okay.
So no LLC level tax for federal purposes.
So basically, as a US citizen and globally taxed, we're not double taxed. So even in this case, they would never or most likely would never experience a
Right.
double taxation issue.
Because the LLC is a flow-through entity.
Okay. So I think in general, we do loans in, besides the US, Canada, Australia, UK, France, Portugal, various countries. To me, at least from this conversation or this webinar today, the US certainly has better tax advantages owning rental assets in the US than it is in many other countries. You don't have stamp duties. There are many deductions, and working with professionals like yourselves to mitigate the tax consequence. I don't know if you're familiar with other tax jurisdictions, but like UK or Australia. Is that something you could kind of expand on, or I'm not sure if that's
Not really, as in doing international tax in the US, we're doing the US side of it. We work with the offshore advisors when we've got cross-border transactions. They look at their side, we look at our side. Everybody comes together, vets it, and decides what works best under the overall structure. So no, I don't really have specific input on that.
No worries. Okay, last question. Can I please get James's contact details to directly reach out to discuss and set up appropriate tax structures in future tax returns? So after the web, well, James can put up his information into the chat, or 𝐷𝐞𝐿, who's running the webinar, can put that in as well. But everybody on this webinar, or actually everybody that even signed up for the webinar, will receive a recording of this within the next day or so, and it will have all of my contact, James's contact, and then you'll be able to kind of rewatch this if you didn't get all the answers that you were looking for. And if you have any additional questions, feel free to either message myself or James directly. We're certainly here to help. James, do you have any last words that you want to, or I shouldn't say last words, but last comments that maybe you want to add on this?
One thing I didn't talk about is international tax treaties. The US has almost 70 tax treaties with various foreign countries. Tax treaties give tax benefits. They almost never are detrimental. And so if you're a resident of a country that the US has a treaty with, that can provide you with some tax benefits in your rental or investment income, especially when you've got investment income. Like I said, there's a 30% withholding tax. Most treaties reduce that rate to 15%, 10%, 5%, or 0. So really important to know if you're in a country that has a US income tax treaty. The other thing is most or all treaties have a residency tiebreaker rule. So if you get in this conundrum where you're a foreign citizen resident and you meet the US residency test under the days of presence, the treaty is going to give you a tiebreaker rule that's going to go through a series of objective tests. And the bottom line is you're going to be either a resident of your home country or the US. So that's a really important provision in income tax treaties.
Okay, so I think that's everything. Thank you, James, for your time. I really appreciate it. Thank you, everybody, for listening in. I hope this was informative. Again, you'll receive a recording of this. So any additional questions you may have that weren't answered in that, feel free to reach out to anybody at American Mortgages, Global Mortgage Group, or James directly. I think 𝐷𝐞𝐿, just if you want to take a look at the chat, James did put his information in, but if anybody would like to write this down, it is his name, which is J for James, his last name Slouber, SLOUBER @cbiz.com. So again, thanks, James. Go back to sleep. Get some rest.
I'll be happy to. Okay.
Thank you, everybody.
Thanks again, everybody.
Yeah, appreciate the time. Bye-bye.